Welcome everybody to the financial planning webinar for independent contractors. I am Cary Facer, one of the founding partners of Warren Street Wealth Advisors, and I'm here to share with you everything that we help our clients who are independent contractors plan for not only retirement, but specifically this year, any tax planning we can help clients with before the year is over. If you need some disclosures, specifically our ADV, you can request a copy. Call the phone number or let us know by email. We're happy to send you a copy of our disclosures. This is our team. That's me there in the center with my business partner to my left in the photo, Blake Street, and the rest of our ensemble team. We are fiduciaries and we are a fee-based firm, and what that means is we have no commissions tied to any investment recommendations we make for our clients' portfolios. And our lead advisors are all certified financial planners. And again, as I mentioned earlier, fiduciaries. And so we always work in the client's best interest, here to serve you in any way that is in planning for retirement. And specifically, this presentation is going to be talking a lot about tax planning towards the second half of the presentation. So what I'm going to do is I'm going to cover what we tell a lot of our prospective clients and clients at events is how to retire. So we're going to quickly go through that. That's the first half of the presentation. The second half of the presentation, I'll give you some specific advice that we give our clients every day here at Warren Street who are independent contractors. So let's start. You're here, so cross number one off. Read the handbook. We have a copy of this on our website if you'd like under who we serve and services. If you need a copy, you're welcome to reach out as well. And we'll send you one. Have a plan, seriously have a plan. Obviously being financial planners, no surprise here, but having a plan is really half the battle, and our clients who take time to plan ahead of these events often fare better than those who don't. So we want to remind you of that as well. If you have debt, let's get rid of it. Other than a mortgage or any low interest rate or student loans where there's forgiveness or interest-free, obviously that's not a concern of ours, but specifically we're talking about consumer debt here, such as credit cards that you carry a balance on. If you use the card, pay it off every month, no problem. But if you do carry revolving balance here, pay that off. High interest auto loans, high interest HELOCs, high interest boat RVs, anything that is above the mortgage, we want to take a look at and get rid of. Budget it out. We recommend you take a look at our toolkit and our handbook, a resource we make available to anybody, and create a budget. It's hard to get rid of expenses if you don't know where the money is going, and the goal of the budget is to identify everything or where you spend all your money. It doesn't need to be perfect, 20 minutes, but basically go through and list out everything you spend on, and then there'll be one or two things that usually stand out for our clients and for myself personally, and those are the ones that bug me, and so those are the ones I work on to get rid of, because a perfect budget does you nothing unless you actually reduce some spending. Keep the things that make you happy, get rid of the things that do not. Build up emergency savings. So once you have gotten rid of some bad debt and you've created a budget, now you have a little extra money to build up savings. We like 6 months of emergency reserve. So if you need $7,000 a month, that would be $42,000. That's money that is not invested in stocks or bonds, but instead maybe in a high interest savings account or a CD, but cash on hand is important for real emergencies. After that, save, save, save. So if you are nearing retirement or thinking about saving on taxes, the easiest place to put your money is in a qualified retirement account like a 401k, a 403b, 457, IRA, deferred comp plans. It goes on and on and on. And at the end of this workshop, I'm going to talk specifically about 4 options that we see our clients use all the time, and one specific one that we recommend pretty much every time. So we'll look at that later. Weigh your Social Security options. Just because you can take Social Security at 62 doesn't mean you need to. You can see it shows here in the bottom. It's a reduced benefit by 25 to 30%. And that depends on your full retirement age. So if your full retirement age on your statement says 66, well, then taking it at 62 would be a 25% reduction in benefit. If your full retirement age is 67 and you take it early at 62, that full retirement age discount back by taking it early is 30%. So it's even more it becomes a bigger issue if your full retirement age is 67. But long story short is if you can wait, that's great. And then every month you wait, you get a credit for waiting. So it's not like 62 or 67. So if it's 64 and maybe health changed at 64, now you decide you want to take it, no problem. You are rewarded for waiting. Weigh your options. Our job as financial planners for our clients is to show them their options. It's your choice because we can't predict how long you're going to live. But we do want to share with you that if you think you're going to live to be into your 80s, you will traditionally benefit by waiting. Here we are again, have a plan. We said it again. Plan. Some little items here about Social Security. So things to consider is collecting while working. Spousal benefits, yes, there are spousal benefits. Our calculators can run estimates for both you and a spouse to calculate which option we should maybe collect on first and defer the other. So this is common for somebody who has a younger spouse by a significant amount of years. The older person traditionally would wait. And if they're the higher earner, that way, if they pass, their spouse will receive a spousal benefit that is either theirs or their spouse's, whichever is higher. So there's a spousal benefit there that we want to look at. Obviously, as I mentioned earlier, health and anticipated longevity. It depends on your health. But again, if you are 62 and you're healthy, we usually advise our clients to wait at least there to that full retirement age, 66 or 67. And again, 70, largest benefit age, there's no increase. And there's an 8% linear per year increase for every year you wait until full retirement age. And then you get that again, that 8% raise by waiting until age 70. So we see a lot of people take it 62. It usually is not the best thing for you. So just look at the options, weigh them, and then make a decision. And last is Social Security going away. There are definitely some issues, but there's 3 ways to fix it. They'll keep deferring the date out, so new payers into the system may receive a full retirement age of, let's say, 68 as opposed to 67. So they'll defer the date. They could raise taxes, and they could also reduce the benefit. So instead of receiving, let's say, $2,500 a month, they might receive $2,450. And those 3 things, deferring the date, reducing the benefit, and raising more in taxes through taxes, is a quick way to help keep Social Security around for a long time. And then the big question is, will my benefit be reduced? Will your benefit be reduced? Most likely not. What it'll be is to be for new payers. That always seems to be the easiest way for that to get passed. All right, so we went through the handbook real quick. And again, these resources are available to anybody that's listening to this. You can buy them on our website or reach out to us, the handbook and toolkit, to get your copies. The toolkit's 2 things. It's a net worth statement, assets and liabilities. I wouldn't spend more than about 20 minutes on these either. The goal here is to actually list everything. And if you don't have a will trust yet, and you haven't gone through an estate plan, this little sheet right here is an easy way for you to just list everything. The amounts don't have to be perfect, but you could put this away with important papers. And if something were to happen to you, a spouse, a child, a loved one, would be able to find this and at least look at this and see how many accounts there are. Oh, I didn't realize, mom and dad had a Wells Fargo account. I thought everything was at Bank of America, as an example. So if you could list everything here, it would make it easy for a loved one to at least sort through what you have. And it's also a nice, easy way for us as planners to talk to clients about this when they come in to say, what do you have? So real easy step here, assets on the left, liabilities on the right. Subtract those 2, and that is your personal net worth, right? It's a balance sheet. This is the budget I talked about earlier. 15 to 20 minutes on this your first time around. For those like myself who love spreadsheets, I usually then take this and we'll convert it on a spreadsheet. We do have that available if you want that as well. Let us know. And then every year, I would revisit this, or when you maybe hit a milestone, like you got your credit card paid off, or you built up your emergency reserves, or now you're maxing out a retirement account, and you're looking for additional ways to save money or additional ways to cut cost, I would go back to this and revisit the net worth statement to see what assets and liabilities you have, and then update the budget as well, just to see where there are opportunities to improve your financial plan. Build your vision for retirement. So we focus so much on earning years that we often forget about the years after, and we're talking about retirement. So this is potentially, selling your business, stepping out of your business, transitioning away from it, and doing something else. And it may be a full retirement, it may be a new career, but we'd like to get our clients to think about hobbies, sports, family time, going back to school, and of course, travel is on everyone's list. Just about everybody's list is number one. And if you do have time, there's lots of local nonprofits, children's charities, and churches and community programs that need volunteers. And so it always feels good to give back. Everybody's leaving Southern California, where we are located. A lot of our clients live. We have clients across about 15 states through the US. So if you're out of state listening to this, that is not an issue. We can work with you. The bright red is the most expensive place to live, according to the study back in 2017. And obviously, weather and relationships are what really help our clients make this decision. We can look at pretty quickly, we can find the states that have no income tax and cities where the cost of living are low. However, if you're there alone and the weather is horrible, it's, either whether it's humidity or, real winters, that may not be worth the $400 to $500 a month in tax savings, or the $400 to $500 a month in cost of living adjustments. Now, if you do move out of state and you want to reduce your cost of living, that is an easy way to fast track your financial plan for retirement. So that is something we see a lot of our clients doing. We just want to be thoughtful about that process and thoughtful about the decision. So what I'll say here is, if you have a city and a state that you desire, travel there during the good months, and then go back and travel during the winter months and spend an extended period of time there, so you can get used to the weather and see if it's something you can do year round. Or stay in California. So if you are located in California, there's a bunch of reasons why you'd want to stay, and even more reasons to stay. And of course, in and out. And we joke about in and out, but the truth is we've had clients leave. One went to Tennessee, and he shares with me quite a bit, is the food's just not as good. And so when they come back to Southern California, one of their favorite things to do is go back to their local restaurants that they used to frequent, and specifically the Mexican food is what they miss most. But we have an amazing food here in Southern California, so oftentimes it is not only the weather and relationship, but it's weather, relationship, medical care, and the food. Those are like the top four that I hear about. So next steps, if you wanted to work with us, I'm going to fly through this, but this just so you have it. This is our process for onboarding a new client. This is how we plan. And then this is how we invest. We have stocks, bonds, and diversifiers, and we do manage our portfolios in-house. Blake Street, my business partner, is our chief investment officer, and we manage and build portfolios in-house. What that means is that we build custom portfolios for our clients. We rebalance those. We can get as creative as we need to with the client strategy. The one thing that's interesting, though, is how we manage that through sleeve trading, or it's just tech, but we have basically three core portfolios: stocks, bonds, and diversifiers, that we can then blend for a client. If we make a change in the stock portfolio, say we get rid of US small caps, we want to reduce that position size from, let's just say if it were 5% down to 2%, all of our clients would receive that trade. So we can build you a custom portfolio, and then we make macro decisions such as reducing small caps. Everybody in our at our firm who we have full discretion to trade for, which is 99% of our clients, will receive that trade. So it's a real interesting way for a small firm like ours to be able to trade like the larger firms. And so that is something that I'd like to talk about, because it is something that's different here at Warren Street. If you have after-tax money, which is cash, this is a non-retirement account. One thing we're doing more and more of is we are decoupling or breaking apart an ETF or mutual fund, and we're buying the securities individually, the stocks individually. And the reason we do this is we can provide additional tax benefits that we cannot with an ETF or mutual fund. There are restrictions here for account minimums. So this is something we would talk to you one-on-one about. But this is becoming more and more popular. the last couple of years. So we think this is something that we want to stay ahead of in the industry, which is custom indexing. And again, owning the stock directly, taking advantage of taxes, potential tax losses through tax loss harvesting that we wouldn't receive with an ETF or mutual fund. So check out custom indexing if you have some time on your own. Eligibility, this is a $500,000 minimum for that account. So obviously it's not for everybody, but if you do live in Southern California or anywhere across the US and you sold a home and you had a $500,000 of equity and you needed something to do with it, you could see how quickly it is. We find clients with the $500,000 in cash and they're asking, what should we do with this money? I talked about those benefits already there on the right. Own it outright and improve after tax return is the goal there. Our fees, if this is a replay, you can pause and look at this. Our fees on the right are for financial planning. We do have are for investments and planning bundled. We have a $500,000 minimum. If you don't meet that minimum, reach out to us because a lot of our clients don't. We get it. We have a custom invoice or pricing model that we can build for you. And it's usually a blend of a fee in addition to whatever your account size is until you get to that $500,000 mark. And then those kind of subsidized fees will go away until we reach that engagement fee of $5,000 here in the bottom per year. And I know that was a lot, but reach out to us. I'm happy to provide you a custom quote for your situation. All right, finally, you went through everything. Now you can retire and enjoy all life has to offer. Now, this is, excuse me, this is the second half of the workshops. That first thing is we cover for pretty much every client that comes to one of our events or wants to know how we work or what we do. Now I'm going to talk specifically about independent contractors. And at the end of the day, an independent contractor is a business owner. I myself started out as a sole proprietorship, and I'm going to walk you through what I went through. I'm going to walk you through what a lot of our clients go through. And this is really one thing where our firm can be black and white. In a world where we can't, it's very difficult to have a kind of a way to do things. This is the way we recommend all our independent contractors proceed when they're at this stage through their business. So first, we would move away from sole proprietorship and form an LLC. If you have no employees and it makes sense, again, this is kind of going into tax, but talk to your CPA about this. But we prefer most of our clients elect S Corp election, so you can be an LLC with S Corp taxation. And the reason you can do that is to be able to pay yourself reasonable wages and avoid paying payroll tax on all your income up to the limits. So as an example, you could pay yourself maybe $40,000, $50,000, or $60,000 of reasonable compensation. And then above that, you could receive a K-1, and that distribution would not be subject to payroll tax above the reasonable comp limits. Again, talk to your CPA on this. I have to say that, but this is what we're advising most of our clients to do. So LLC entity formation. So if you're in the process of business entity formation for 2022, you may need to have your documents signed and filed prior to the end of the calendar year. So what this means is if you haven't formed an LLC yet and you want to get started with your planning, is you may need to get all this done before the end of the year. And we're recording this in September, so you have time, but we wouldn't wait around. Bookkeeping is a big one. So if you already have bookkeeping, you can ignore, but you know how important having good books is. However, if you're a newer business or you just have not got around to getting your books in order, this is an important step. So if you have the LLC and you have a business entity and you have an EIN, and whether or not you've elected S Corp, that is not required, S Corp taxation, this could all just go through to your personal return on your Schedule C as business income. And what you want, though, is you want good books. And so you want a separate checking account for all your money that comes in and all your money that goes out. So not your personal checking account, open up a business account, have all your money come in and out of that one. Keep diligent records and invoices and receipts, and hire a bookkeeper if you don't want to do it yourself. This is just so important to make your business world and your personal world separate. And of course, you'll accidentally use a business card for a personal or personal for business. It happens, but having a good bookkeeper is so important. So on a, whether it's weekly, monthly, or quarterly reconciliation, they can catch those and correct them. And that way they can provide good books and records to your accountant, so your CPA can file returns in a timely manner and hopefully help you plan for some of these tax saving ideas that I'm sharing with you now. So retirement account. Now this is back in our lane of what we do. And when we see a client who has a successful business and they're an independent contractor, most popular is an IRA. But the limits are low here. So we usually see clients move above those limits to a SEP or a simple. And usually the SEP and simple comes back from a recommendation from their accountant. What we like to see our clients do, because the limits are higher and there's a potential for a little bit more deferral here, is a solo 401k. And the solo 401k is just like a 401k, but it's for an individual person. So one person, and they can have a spouse on as well. That spouse does not need to work in the business. So if you have no employees, this is the route. And so if you're an independent contractor, no employees, a solo 401k is what we recommend for just about all of our clients. And if you stay under $250,000 in the account, you don't have to get a third-party administrator, which is an additional fee. So some employers with 401k plans don't like them because they're complicated, they're expensive, and they're not easy to administer. I get it. We have one here for our team. However, if you're working with us, this is something that's pretty easy for us to implement for our clients. So we recommend a solo 401k. If you already have an IRA, if you already have a SEP, or you already have a simple, you can roll those monies into your new solo 401k just to consolidate and keep your life simple. All right, questions. This is where we open up for questions, but I am recording this for everybody. So if you have questions, we'll have our contact information available and you can reach out to us. If you go to our website and you want to schedule a complimentary consultation, no strings attached, you can book an hour with myself, Blake, Lynn, or Emily on our website. You can give us a call or you can email us. We're happy to help you with this. And finally, our guarantee is we promise to put your interest first. As I mentioned in the beginning, we work on our clients' best interests as fiduciaries and as our lead advisors. Justin and Emily and Blake are all have the CFP designation. That is important to us, and we want you to have an opportunity to talk to an advisor and not feel like you're going to get sold anything. And so that is my promise to you. It is a true consultation, no strings attached. All right, that was a lot. Any questions, let me know. And thank you for these two sources here. And we're all done. So thank you for attending. Again, Cary with Warren Street Wealth Advisors. I want to thank you for spending time and working on your business today. Any questions, let me know. Have a great day, everybody. Bye-bye.